France's leading banks have been downgraded by Moody's. However, a senior BNP Paribas economist says Europe will avoid a Lehman Brothers-style collapse. His confidence comes exactly 3 years since the Wall Street behemoth went under. Economy Reports has more.
In an interview with CNC, Philip Gisels, head of market strategy at BNP Paribas Fortis, says the Lehman's collapse taught policymakers a lesson on the uncertainty of financial markets.
Lehman was extremely bad, and it was indeed the first stone in a sort of motion that brought down a lot of the financial system. So Lehman was very bad in a way because policymakers, after having saved a number of banks and investment banks, they let Lehman go bankrupt. Lehman was thought, okay, it's a reasonably small bank, so it will not have much impact on the system, but it did, because people started to think if one bank can go bankrupt, maybe another can follow. So banks did not trust each other anymore, which brought down confidence in the market system, froze up the credit market, with all the negative consequences that we have seen since.
The latest downgrade of France's leading banks has raised investors' fears and revived memories of the Lehman crisis.
Banks, now the debt is on the level of the governments, but it's still the debt, and sometimes the same debt. On the other hand, I think there are a number of big differences. First of all, I think that policymakers now have learned from Lehman that if you let one bank go, you have a very negative impact on the market. So if you take the same reasoning, if you let one country go, it will immediately have a negative impact on the other ones. So I think that policymakers will do whatever they can to come together and come to a common solution, and eventually the markets that go down and the economic figures that turn worse force policymakers to come together and come to these measures, and eventually they will. Of course, nobody knows how much pain there has to be first before we can come to that solution.
On Wednesday, Italy passed a €54 billion emergency budget plan. It aims to balance public finances by 2013 to shield the country from a debt crisis. According to Philip, this is a positive signal amidst a backdrop of expensive borrowing costs. Early this week, French banking shares were pulled down by fears over the Eurozone debt crisis, which triggered a major sell-off and kept investors on edge.
It's clear that the last couple of weeks the level of interest rates that banks have to pay to one another has increased. So it stands now at the highest level in more than a year, but still substantially lower than it was back in the Lehman times, because then really the credit market froze up. Now you can say credit has become more expensive. It's more expensive to have loans between banks, but it is nowhere near it was when Lehman froze. And the Lehman freeze up was clearly because you had the bankruptcy and the banks did not trust each other anymore. Now you can say the price they have to pay for credit is higher, but still there is no distrust between banks, so the system works normally in a smooth way, only you have to pay a little bit more of interest. That's a big difference with what we had 3 years ago.
For the first time in history, the U.S. Treasury Secretary will attend the Eurozone Financial Chiefs meeting on September the 16th. During the meeting, Timothy Geithner is expected to urge the finance ministers to consider upping the capacity of the Eurozone Rescue Fund.